This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Podcast guests and their clients may maintain positions in the securities discussed in this podcast. Hello and welcome back to the Three Wise Monkeys podcast, a weekly podcast that's all about the markets and investing. My name's Andrew Page, founder of strawman.com, and once again I'm joined by my co-hosts, Mr. Claude Walker from Ethical Equities.
Hi.
And Matt Joss from mattjoss.com.
Thank you, Andrew. Very happy to be here.
Guys, what are we going to talk about this week? Claude, you've been doing a bit of research today, a lot of reading on results that are out.
Not so much research, but just keeping up with the quarterly 4Cs this afternoon. I've a lot to catch up on.
Okay, some good news, some not so good news. And as it has been long promised, we are going to try and check off a whole bunch of questions we've got from viewers. And as always, thanks for sending those in. We'll do our very best to answer them. But first, Claude, we are going to talk about a number of these quarterly updates that have been released to the market just this week. First, tell us a little bit about why it is that some of these companies are reporting quarterly. Most people will be aware of the 6-monthly reporting requirement. Why have we got these companies doing quarterly reports?
Right, so some of the companies have to report quarterly because they haven't reached certain cash flow requirements.
Right.
But others, such as Dicker Data, just choose to give a quarterly update.
Oh, very nice of them. Shall we start with Dicker Data?
Yeah, sure. You know, that's a stock that I've held for a while. I've liked it for even longer. Shout out to Tony Hansen for, in fact, first introducing me to that one.
Hi, Tony.
It's a great dividend stock. It has management that we've talked about before on this very podcast. They put out their quarterly guidance, I guess it was today. And the good news is that they're going to beat their previous guidance by about 8%, they say.
And shares shot up 6% or so in the wake of these results.
Well, that is actually a pretty big move for Dicker Data. I should mention, by the way, that revenue is going to fall just short of 1.5 billion. So they didn't get their revenue quite right in terms of their forecasts, but a little bit of margin improvement sees them doing very well.
Great. And just for those that aren't familiar with Dicker Data, what the hell do these guys do?
They're basically distributors for IT equipment.
Hardware, componentry.
We've talked about it on another podcast, and also you can find it's a hidden report on Ethical Equities on Dicker Data, but I'm happy to see that one because it's a hidden report. I'm happy to see that in particular do well. It's a big holding for me, my 5th biggest holding, and I actually topped up a little bit more this morning.
I was going to ask you about that. So what in particular was it that made you feel as though you needed more exposure to Dicker?
I just like to gradually accumulate companies that I think are high quality stocks. And I believe that it takes years to really get to know whether management are as honest and competent as I would like them to be.
Yep.
And so far, I just keep on liking what I see from Dicker Data.
You know, I find it I don't know about you guys, but I find it a very tough discipline to do that. You buy into a lot of these companies, and all of us like the small cap space, and there'll be some certainly early stage companies there. There's a lot of potential, a lot of excitement. That's why we buy them. But then in those instances where the thesis starts to play out, it can be psychologically hard to buy more when that's sometimes at very high percentages above what your initial buy price is. Matt, do you struggle with that?
Yeah, I think it's a core lesson for me over the last few years. I kind of sum it up as buy low and then buy higher. Yeah. So trying to buy more of a company as the thesis unfolds. I think it's a really good approach. And I think you need to do it just at least a little to overcome that bias because you anchor to the price you first bought. So I think continuing to buy as the thesis unfolds is really good.
And it's that issue too of, yes, okay, the price isn't as good as it once was, but the outlook is far more certain. So you are paying a higher price, but at the same time you're getting a higher degree of certainty.
Yeah, more certainty, and hopefully the intrinsic value increases over time, right? So it's not a one-time thing. Some new news comes out, you can upgrade your valuation estimate and buy more if it's still cheap.
In fact, in that line of thinking, you might actually pay a higher price but get better value.
Yeah, absolutely. It's very possible.
All right, let's move on. We've got a lot to cover here.
Okay, so before we move on from Dicker, so that's clearly still a buy from you and one that listeners should check out.
Yeah, it's a good stock. I really like it.
How about Volpara? Now, Volpara, you're also a shareholder in Volpara?
I do own a very small holding in Volpara. I sort of progressively sold down when it was trading around to $1.40.
I think you've mentioned that previously. Yep.
Yeah.
Yep.
So I sold down mostly because I thought valuation was stretched and the guidance was very optimistic. And after the last quarter's result, you could see.
So the ones that released just this week?
No. So the ones that were released today was the Q3 results. After the Q2 results, you could see that if you modeled what they would have to achieve their guidance, they had to have like basically this heroic acceleration of ARR, which is annualized recurring revenue growth. So to my mind, it was not very, but like likely.
And was that guidance, Claude, given when they raised capital?
Yeah, so that guidance was given around the time, I can't actually recall exactly, but it was around the time of capital raising. So I guess, it makes sense for them to be as optimistic as they can to get as high as price as they can. But it really just took off after that. The price they raised capital at was still totally reasonable in my view. Actually, I wanted them to raise capital at a slightly higher price. So I actually think the people who had participated in that got a good deal. However, it became very unlikely in my mind that they would achieve their guidance, and they have indeed abandoned their guidance today. Now,
by how much have they moved away from that?
So by my back of the napkin calculations, their new guidance is 6.66 million in ARR by year, at least that much by year end.
And what was the prior guidance?
It was 9 million.
So that's a pretty big change.
Yeah. It's hefty.
Yeah. So this announcement came out today, and I kind of quickly scanned it through and didn't pick up that nugget at all. It was only when I read Claude's tweet that I kind of realized, I guess, what had happened.
Yeah,
so it's
right.
kind of
So the reason for that is
easy to miss, right?
Well, yeah. In the announcement, they said we now guide for ARR 85% over last year. So you had to go back to last year, do 1.85 times 3.6 to get the new guidance.
Yeah, no mention we are not going to achieve the target we'd previously given.
And now on the earnings call, the CEO sort of outright said, it was previously 9 million, now it's this.
Yeah.
I don't think he's the kind of person that would have wanted it announced that way. Certainly if I speak to him again, I will point out that he should have just said, hey...
Yeah, I mean, this stuff always comes out anyway, right? It's not like no one's going to do that calculation.
More,
exactly.
I've done more than most to support the bloody... but to support the share price, and now it's egg on my face for them to not just be absolutely upfront, and if anything, they should have downgraded guidance last quarter, which I made it clear to a number of people that I thought that it was getting fully priced, and in the end of the day, unless you're raising capital, the company doesn't really benefit from having a super expensive share price. Either way, I still hold some shares. Usually I'd probably sell out of a company that had this sort of massive downgrade, but I still hold some Volpara shares because I consider it a ethical investment. I want the company to succeed, and long term I could see myself buying back in a more meaningful way if it was offered at a more attractive price.
Just a quick recap on what does Volpara do very quickly?
So they basically have technology that helps better assess the breast density of women who are having mammograms. And this in turn can basically help spot and stop breast cancers. So they have good technology that can save lives. It makes sense to be investing in this as a society. We can use increasingly like AI and machine learning to sort of inform this sort of diagnostic medicine. And so, I really hope that they succeed.
So shares down almost 10% today. For those people who might be listening who haven't heard of it before and maybe are considering buying in, is that an opportunity now, or is this one that's sort of...
Is it cheap today?
Yeah, is it cheap today?
So I recommend you check out the graph on ethical equities that I just posted. Basically, you can see that their new guidance is just for a continuation of the current rate of growth. Now...
Which is pretty decent?
It's pretty decent, but I don't know if it really supports the current valuation. As I said in that short update, even if we assume that they beat their guidance, which I think they will, because surely they wouldn't be so silly to do one that's too high again. But I think they'll beat the guidance this time. And then even assuming that, so I've just assumed maybe I think they can probably get 7.5 million in ARR by end of year, which is one more quarter away. They don't have the normal reporting.
Yeah.
Even if they get that, then they're still trading on around 25 times recurring revenue.
Yeah, it's pretty lofty.
Yeah, so
forecast recurring revenue.
Yeah, so I think I like to compare unprofitable software as a service companies to Pushpay. And because I know Matt loves Pushpay, and so I asked myself, is this stock really better than Matt's favorite? And put it this way, in the same time period that I was selling Volpara, I was buying up on Pushpay. It looks better to me on a better price, but we'll see what happens there.
Fair enough. And anything else come across your desk today in terms of these quarterly results?
Yeah, well, so earlier this week, there was... or actually, we'll talk about one today and then we'll finish on a high.
Okay.
So one today, which came across our desks, and Matt actually pointed out the second announcement to me because it was laughable, was one called Locality Planning.
Right.
Yeah.
And just to start, what do these guys do?
Look, I'm not totally across this company because I do not have sufficient confidence in them as a business to want to really understand their business model, but it has to do with providing power to strata and then increasingly other people. So they're basically in the retail.
More from the billing side of things as opposed to... Are they
Don't quiz me on this business.
Okay.
I'm here to talk about the ridiculous announcement that they put out today.
Hit me with that then.
I don't know why I should... Tell me, after you hear this, tell me why I should spend my time trying to find out what exactly
I guess we mentioned it though because it got a real buzz within the small cap community there for a while.
Well, people didn't like it when I started criticizing it.
That we respect, making some pretty good cases for it. So what went wrong? What was wrong with the announcement?
Okay, so on Friday at 7:17, an announcement came out that said...
in the evening. This is
in the evening.
Before the long weekend?
Yes, before the long weekend when everyone's going on their holidays or they're like clocking off or having a few drinks or whatever, and they're not going to check back in. They put out a announcement to say that the revenue is going to fall very short of what they'd previously said, but that NPAT would be unaffected, and sort of this obviously put up alarm bells. The fact that it's at 7:15 p.m. on a Friday night is holy moly. For me, this is like a heuristic red flag. This is what I got out of following stocks that I didn't like. Is you got to see the patterns of companies that you never wanted to invest in. So one stock that I had to...
Tell me where I'm going to die so
exactly.
I never go
So
back.
one stock that I had to follow as it descended, in fact, you might know a bit about this company, Andrew, is Yellow Brick Road.
Oh, yes.
And I had to write
old
about
Yellow
this
Brick
company
Road.
as it sort of slowly fell from
From
50
grace.
cents to 10 cents.
Do you still own it, Andrew?
What?
I've never owned it.
Oh, you never owned it?
No.
Okay.
Whatever discount to tangible value it now trades at. And so this was such a perfect one where I would never buy this stock because I did not have confidence that whatever value may be created somewhere would fall through to shareholders. And indeed it has not. And now that's what the market is saying.
So it was a lesson and then one that you can roll forward to other...
But one of the patterns of this company is at the end of earnings season or the end of the quarterly reporting season when everyone else will have done their stuff, at 7:15 or 6:15 or 5:15.
11th hour.
The very last minute. Then it was just always the last minute.
Can I ask you this, though? Is there
I'd always have to finish it on this sort of low of our underlying profit was good if you exclude X, Y, Z.
Good old underlying profit.
Anyway, so this is why the 7:15 announcement put off alarm bells for me. I put out a tweet saying this is off the watch list now because it had been on my watch list just because other people who we think are smart and good investors, and everyone makes mistakes, do like the stock.
Yeah.
So, I was
you
watching
pay attention when people you trust make a noise about a company.
And also, I get terrible ones wrong as well and lead people astray. So it's fine.
People in glass houses.
I'm not saying there's
100%.
anything wrong with liking the stock, but to me, that is a red flag. And then hilariously today at 3.50, right? So if
10 minutes before market close.
So if you'd sold on open today, you could have sold at 75 cents. But what would have been required would have been... Actually, someone replied to me on Twitter. I should get the guy's name. He was bang on point because he replied saying it's not possible for NPAT to be unaffected. It makes no sense. And he had some numbers to support it.
Yeah.
So this is free on Twitter. Some guy is just absolutely laying it down. And if you'd sold on that at 75 cents... It closed at 65 cents.
Right.
And
that was 10 minutes after a revision to the announcement.
I'm not exactly sure what happened, but I imagine what happened is at 3:50 it went into like pre-open trading halt as they did a new announcement, which was that, it had been a typo. Profit is not unaffected. Profit is in fact affected.
Did we say unaffected? We meant affected.
Oh, I guess no
Significantly affected.
See, I guess another problem with releasing announcement at 7:15 before a long weekend is that maybe like you've rushed through that and haven't
investor relations are more focused on other things.
Someone forget to proofread that.
Can I again? Is there ever been an example in the history of the world where a company has made a really bad announcement, very, very at like the last minute, and then it's just been forgotten about by the time trade resumes? Like, does anyone ever get away with it?
I'm not even trying to say that they're like trying to bury it. I'm just trying to say it's poor form.
It's total poor form. And my point is, it's poor form, but there's no benefit to it anyway.
If I sent you an important work email at 7:15 on the Friday, I would quite literally preface that with, "Hey, I don't expect you to even read this until Monday," but blah blah blah.
So one of the replies that I saw you get, and I actually thought it was a pretty good one at face value, which is that, well, Buffett releases his annual report just after close on a Friday, and the argument being is that it gives investors the maximum amount of time to digest all of that new content before trade resumes. So it helps, the argument goes, that there is a far more informed market when trade does commence again. Yeah. What say that? Use of that?
I think that is perfectly sensible. However, with like absolute respect, I don't think Buffett's 100-page annual report is analogous in any way to this half-page announcement.
That's a pretty good answer. I'm
gonna say it's fine. And if you want to invest on the basis that it's a half-page announcement is the same as a 100-page report,
sure,
that's fine.
Yeah.
Maybe when you read a downgrade, you want the weekend to meditate on it.
Right.
That you could also argue. Mm-hmm. Me personally, I would much prefer the announcement come out at 9:30 in the morning on a Monday, but actually be correct.
Yeah.
And maybe if they'd waited over the weekend and proofread it with fresh eyes, they would have got it correct.
Yeah, or fix it on Monday morning.
Or even even proofread it at any point between when they posted it on Friday and then trade on Monday. But like, how did that go through the whole day of trade on Monday?
And again, this is a short document, right? It's like a half page.
So
how much digesting?
So they basically sent this off on Friday, and then they're like, "Oh, we're done, guys. Let's go on holiday."
Beer o'clock.
Do you think there's some poor person that had to type it up on Friday and just like wrote it down wrong or something? Like, how does this happen?
Who knows? It's not even about that. It's just like, to me, this sort of stuff is CEO level.
Yeah.
Like, you're communicating something disappointing to your shareholders.
Yeah.
You should be involved in that. So
another thing I quite enjoy is sometimes when they update to the ASX, you'll see the file name that it was saved under by them, and so it'll be like final version 4 final. And so you just imagine all the sweat, which probably wouldn't have happened in this case, right? Of just bouncing back and forwards as someone revising.
It was probably like document 1.
Yeah, document 1.
So I guess bottom line is this like an instant.
I'm not saying that the business is bad. I understand that I'm probably missing the investment of an opportunity.
But if I can paraphrase you, and I should put my hand up, I have done no research on this at all. It seems like a very distressing red flag.
Yeah. So like, my hair's already thinning, and I don't need the extra stress of companies that do this sort of thing.
Fair enough.
That's a good way of putting it.
Hey Matthew.
Yeah.
Should we do some questions?
Wait.
Oh, there's more.
One more.
One more.
So we're going to kick this one off with Matt was going to perhaps tell us a little about the business. So, and the business is Audinate.
Yeah.
Audinate.
So I'll do a little intro on the company. Claude and I both like this one.
No, that's ASX AD8 is the ticker.
Yeah.
Correct. Tell us about Audinate.
Yeah, I'll just quickly update on what the business does. So it provides audio networking solution, which is both software and hardware based. And the key thing that they do is allow really high quality audio to be sent over Ethernet cables. And currently, most of the industry, the vast majority, 95%, is over traditional analog cables, which are needed for a few reasons. It's really hard to do it over digitally, but Audinate kind of cracked the code and have a standard that the whole industry is kind of building around. So they've got very large market share. And these things tend to be winner take all because everyone starts building to the Dante standard. So yeah, very attractive
Dante being their product.
But Dante being their product.
And what's really exciting about this is that there is a legitimate structural shift in this industry.
Yeah.
And this tiny little ASX listed company, or relatively tiny, is the legitimate world leader in this. And like some really big name clients, they've got some really, really great traction. Things seem to be going well.
Yeah, and you go back to like the early 90s when companies would own a technology like this. It's really powerful. So the customers are quite sensitive to someone owning that much, having that much power in the industry. But they've managed it really well and been really customer friendly. So it's going very well at the moment. But yeah, and then they released a latest quarterly, which Claude covered for ethical equities and might be able to run us through.
Tell us all about it.
Super psyched that Matt read my update, even though it was really short.
And it was very quick.
You only had to email it to him 5 times. But
I think I did actually ask for comments. Maybe that's why I read it. Anyway. So,
by the way, I'm going to put the links to these blog posts to your website in the show notes.
Oh, you're welcome to. Anyhow, the main point is that they did manage to collect record receipts from customers.
Great.
Which is always nice to see.
Towards a level that they had indicated was they were on track for?
So they didn't give any sort of cash flow guidance. They've got revenue guidance, which still remains pretty plausible. One thing I would keep in mind is that last year, the third quarter was actually below the second quarter in terms of cash flow. So I don't know if they've got some sort of pattern going on.
Seasonality effect or something.
Yeah, exactly. Yeah. So I wouldn't be overly disturbed if we do see a little drop off next quarter. As a result of that, I'm sanguine about the share price right now. I'd probably wait for a slightly weaker quarter. Having said that, it is one of my bigger holdings.
We should do more of a deep dive on this one of these weeks because it's something that's certainly
actually,
piqued
do you
my
guys
interest.
own Audinate shares?
I don't, but I've
Matt does.
The fact that Matt owns it and others that I respect has really made me think I need to do some work.
It's not a major position. I don't want to oversell it because the valuation. I think Claude and I are both sensitive to the valuation, but it's a very good business.
It is pretty highly valued. I'm not buying at current prices. I'm holding. Okay. I think it's a long-term story. If it's going to play out, there's going to be plenty of time to watch revenues grow year after year after year after year.
And it's one of those things, given the size of the industry, that pretty eye-watering level of growth could actually increase and be sustained for many years yet, right?
Yeah, so it'll be affected by the overall consumer spending indirectly, but it should have semi-recurring, I say semi-recurring revenue because every time its customers sell something, they're going to be paying Audinate.
Yeah, highly repeating revenue. Yeah.
And this kind of growth model is something I really, really like because it can be one of those situations where someone else's capital is growing your business. So every time one of their customers invests in a brand new product, markets it, sends salespeople out to, get people to buy it, that's their capital. But Audinate just gets a little bit out of it.
Just clip that ticket.
And I love those kind of businesses.
Me too.
Because they couldn't get higher levels of profits for longer.
That's fantastic. Really so you're happy with the update? Shares are up almost 2% today.
I didn't think it was that amazing. It moved up a little bit prior to the 4C, which is something I never really like to see. I never like to see a big move right before results because I wonder if someone uses it.
I like it. I like it more than when shares fall before.
That's worse. But even then, I don't think that there was. I don't know why there's anything in this that would necessarily make people want to jump on all of a sudden. There was, big sort of venture capitalists selling down a while ago, and I think super funds buying, so that's interesting as well.
Okay. All right. Well, one to watch, and we might circle back on that in a future episode. Gents, let's, in the remaining minutes that we have, let's burn through some viewer questions. Some might call them listener questions.
You can view on YouTube. The picture doesn't move.
The picture doesn't move, but you are technically viewing.
Yeah.
We had a bunch here, so let's get through some. David has written in. We have known him in a former life as Uncle Wally, is one of his online user names, and he says that he'd like to hear our opinions on any international ideas we might like or own, and possibly a quick rundown on opening an overseas brokerage account. There is a little bit of stuff that's involved there in forms and that. Is it one of these things that's really too onerous, or is that just a convenient excuse for not getting it done? Matt, let's start with the first part of that question. what are some international ideas you'd like to highlight?
Yeah, so I don't. I focus very much on the Australian and New Zealand stock exchange. So New Zealand might count, but I think he's thinking a bit broader than that.
I think he's probably.
I don't think we know how to buy New Zealand stocks.
Yeah, that's true.
There's a stock market there.
This is why I love it, because no one else is looking.
You have to fly.
This is like my dream, is to have no one else looking at the share market
efficient
while I look at it
markets.
all day.
So I think the way you buy New Zealand stocks is you wait for your mate to start a New Zealand stock fund.
Yeah,
and then you
that's
give
good
him your
happens.
money.
Oh, very interesting indeed. So
But yeah, so thinking more globally, I guess. One that I'd covered previously on here was Facebook. But that's a very painful stock to own, because every day you're just bombarded by all the terrible things the company's doing.
yes.
So I don't know how gung ho I should be on that company. But
But
yeah,
I'd refer David back to
that
our
podcast.
previous
Yeah,
episode, because
for sure.
I think we had some good things to say on that.
Can I hit pause on that just for 1 sec? So how do you guys invest overseas?
I actually don't do any direct investments overseas. I do it all through ETFs.
And Matt?
Yeah, I open a brokerage account. Charles Schwab is what I
Yeah,
use.
right.
Yeah, I have another account as well, but yeah, that's the main one that I use.
So I just use ComSec,
Well,
which I'm not saying is the best way. Or anything.
Yeah, there's basically ComSec's okay. I think the fees are relatively high, but
It's $20 a trade
Okay.
for US.
it
Yeah,
used to
that's
be
not too bad.
$100.
Yeah,
Wow,
it
it's
used to be
$20
high.
now.
okay, that's
But-
okay.
Oh, there's no excuse, right? Then, like,
The thing is, I'm pretty sure. I think maybe only US is the only one you can do online
Right.
with ComSec. I'm not sure. That's the only one I've ever done.
so look, okay, there are some forms to fill out. It's a hassle. Like, no one likes to fill out forms from any kind of bank or financial
It's not
institution.
that. It's actually not that.
But it's
bad.
not really that hard. And within a week of today, you'll be able to trade
It's harder to-
directly
do you know,
in overseas markets.
It's harder to set up a account with interactive brokers, which I almost did a bunch of times. You have to jump through a lot more.
I have an
hoops.
account with him. I wouldn't recommend it.
I hear great
Yeah.
things about the platform, though.
It's very advanced. You feel like
Right.
you're taking off as like launching a spaceship every time you log in. It's like you're very afraid to touch
Wait,
anything.
so you have
Wow,
Charles
okay.
Schwab and interactive
Yeah.
brokers?
Yeah. And interactive brokers is like you have everything. You have options and like
Oh,
it's
Yeah,
all
is
sort of
okay.
stuff.
that why you got it?
Yeah, that was primarily where I got it.
But I guess the
Yeah.
point is that there's a lot of great opportunities out there. 98% of global equity markets are outside of Australia. And B, yeah, it's a bit of a hassle, but it's not something that should prevent you if that's what you want to do.
Yeah, for me it depends on what your style is. Like I am quite a like most of us, I think, quite deep research kind of investor. I like to own a few fairly concentrated and do a lot of work on them.
Yep.
And for me, it's not really. That's why it's not a big focus in the US. It's just there's so much. Like New Zealand, you guys don't even know
You
there's a stock
prefer New
market there. I
Zealand.
prefer that kind of
Yeah.
that kind of end of the market. So occasionally, like I have a small percent of my total portfolio in the US. Partly that's just to have some money in US dollars. So I'd say it depends if you're like buying a big broad swathe of companies, which a lot of folks like to do. Then that could be a good reason to like own some of the best companies in the world in the US.
I'll tell people what I own in the US. Actually, I'm like you. I have a very small amount, and I actually learned that the hard way. I feel like a bit disappointed because I thought, I'll buy some of these big companies, and then after a little while, I thought, I don't know anything about these companies relative to how well I'm used to knowing.
Yeah, and
Australian
particularly knowing
small
better
caps.
than the next best investor there, right?
Exactly,
The next
and
analyst.
that's
Yeah,
the
the
thing.
4,000
I'm
people
like,
that
my
really
return.
cover
You know,
this.
even though if you focus on like, if you'd bought Netflix in 2013, you'd have been a genius and made so much money. That's what I was focused on when I was like, I have to start investing in the US. The reality is that I don't have any informational advantage in buying these stocks. So I'm actually much more comfortable with some like 20 like laser bond or whatever I doubled my money on in 6 months.
Well, it's different if you're running a
Which I
$100
still
billion
hold, but I don't
fund.
think it's a buy.
You can't do what you're doing, but I think it's fair to say none of us are doing that. So it's
I
actually
much
an
prefer
opportunity.
the small cap stuff. However, just pretty much to alleviate my FOMO, I bought Match Group,
Which
and
who own Tinder,
they own Tinder, yeah.
amongst and also Match.com. So
Don't-
they own dating, right?
Don't make my investment thesis too complicated, man. And I own Atlassian because
Yeah.
it's Australian.
Nice.
Very patriotic of you.
By the way, there's $750 in there before you like.
Don't get too excited.
Yeah.
High roller.
And actually, the one stock that I've done really well at on the US was 100% because of Dr. Anaban Mahanti, who told me to
doc.
buy it. and I blind followed him.
Which one was that?
It was Altrix.
Oh, nice one.
I
Doc.
think that went up like
Yeah.
more than double since he told me.
Good one.
And he was like really excited about it. And I was like, okay, I'm going to do what you're doing. And also own Google. And so most of it's just Google. And I'm just going to keep buying Google.
Yeah, yeah. This actually segues nice into the next question, which is from Daniel. He gives us a nice shout out, enjoying the podcast, learning much wisdom. Big thank you. I'm looking at an ETF. ASX code here is NDQ, which gives access to high US market leaders, specifically the NASDAQ here, and appropriately weighted as such. I would like a discussion a bit about this and some insights into the risks of ETFs in general. Now, ETFs have come up a few times. And I think the reason I say it segues nicely into that formal one is because that's how I get my exposure. I prefer, I've only got limited time. I prefer to focus my efforts on the ASX. But like you, Claude, I have serious FOMO. And I feel as though I'd have a lot of explaining to do to my children and grandchildren if in 20 years' time I say, yeah, I spent a good part of my life investing in markets, but I chose not to invest in Google and Facebook and Amazon and the rest of it. Do you guys have any particular insight into this ETF, or do you have a comment about ETFs in general? Claude?
I'm not convinced that it's better to buy the ETF, we're talking about the NASDAQ ETF, over just buying Google shares. That's my comment. However, I know a lot of people who do buy NASDAQ ETF because they can buy it on the ASX. And if that is the main reason that people buy that over just Google shares, then I'm going to take my Google shares and go.
Isn't it also about diversification? As great as Google may be, and again, we should probably do an episode on that. Yeah, but you know, there's
diversified. It's everything.
There's Netflix, there's Atlassian, as you mentioned, there's Match, there's all of these other ones.
They're all dependent on Google.
Advocates of ETFs would say that yes, if I buy this particular ETF, I actually get exposure to Google, plus I'll get exposure to a whole bunch of other stuff as well.
But if you buy Google, you get exposure to everything.
Yeah, oh man, I'm resisting the urge to go down that rabbit hole because there's so much to say. So, but in principle, are you like Matt very eloquently said before that unless you are prepared to sort of do the deep dive and feel as though you've got some advantage, is that a very, very tall order when that for orders of magnitude less effort, you can still get a great deal of exposure and very likely probably beat all the professionals in that space.
Let me just say this. Sorry.
Go on. No, you can't leave me hanging.
Okay. Well, if you Google Amazon, the first result is a paid Amazon ad.
There you go. That's good. So the question was about the NASDAQ ETF or in general ETF? Yeah.
Do you ETF?
Yeah. So I used to use it with a portfolio that I managed, ETF sometimes, and it was primarily a way to get a exposure to something that you can't get in Australia. So I think that's quite good. If you wanted exposure to the Aussie dollar for some reason in your portfolio, to the US dollar, you can do that via an ETF quite easily. If you wanted the big tech companies, and there's not very many in Australia, then that NASDAQ's not a bad idea. I prefer more specialized ones, previously invested in the global cybersecurity ETF, Hack, which I don't own currently, but
Whoa! You don't own it anymore?
No, I'm more concentrated these days.
So it wasn't any reversal of opinion there. It was just you preferred to. It was an opportunity cost.
Yeah, exactly.
Calculation.
Yeah.
Okay, cool. Last one, and this one comes from Christian. This is a really interesting one. It's a very short question, but. Man, there's a lot to say here. He says, if there's a route, if the market just gets into a bit of a tizzy and falls significantly, he asks, do you jump in straight away or do you wait? Who wants to tackle that one first?
I'll have a go.
Okay.
So you should wait until the market bottoms and then you should buy.
Wait till the exact bottom and then you jump in.
No, my opinion is that you shouldn't be thinking about what the market's doing. If you're buying individual companies, you should be buying individual companies. You might think that there's more panic coming, so you might not try and deploy everything the second you get a 10% discount. That's something to think about.
Right.
But it should really be about the individual companies that become at extreme fire sale prices.
That's the sweet release you get from not trying to buy all of the stocks that you read in all the financial media and all that sort of stuff. When you're really if you're willing to actually do the effort to do research, that is the sweet thing, is that some small cap stock that's having its sales go up is going to have its share price go up, or if it's got profits, regardless of what's going on.
Absolutely.
And if nothing else, even in the sort of GFC style event, it'll at least hopefully there's some stocks you own that'll at least keep paying dividends.
Yeah, and I've been both. Like, there's definitely times where I feel like if you don't have enough good ideas, it's quite stressful.
Yeah.
If you don't know where you want to be deploying
Yep.
cash. But then if you're doing the work and you have those ideas, it becomes a really exciting time. And so, like, I think that's the thing to think about. Like, if you're nervous that the markets might fall, to me, at least, the way I think about it for myself, it means I haven't been working hard enough to find ideas. Right. Like during that December crash, had a bit of time off and was just focused purely on investing and was extremely excited when the market was crashing and was hoping it would crash more every day and was disappointed if it didn't because I had a few companies that I was like very excited to be buying.
Waiting.
But at other times, obviously, if you don't have that, suddenly all that stress starts coming back in.
And what matters, of course, is whether or not you're buying this thing at a level which represents actual value. I mean, if you do that, even if it happens to be 20, 30% away from whatever the eventual bottom is, by definition, you will get a good return. And that's not an easy thing to do, but let's just contrast that with the actual difficulty involved of timing with any precision major turning points on the market. I just don't think it's going to be... Could you do it? Possibly. Okay. Should you do it? If you can, will you likely do it? Probably not. So focus on the thing that's going to be far easier.
So I think the most important thing is have a setup whereby if the market does crash, you can over time gradually deploy that capital in. Not all at once. Don't jump in at 1 minute. Gradually deploy as stuff's going down, which is I think what Matt was sort of explaining in his mindset as well.
That's 100%. And I just reiterate the point that it's more about where the relative value of, that definition of is the current market price less than your value of the company, and if so, do that and everything will come out okay.
But that's a good segue. There's fewer and fewer places where you can actually learn about valuation, find out about valuation. We have our mate Owen. He's got a good resource for valuation, but also
he does.
Strawman actively invites people to share valuations, and you can look into the revenue, profits, and all those sort of forecasts.
I'll slip you some cash later, my friend. Thank you very much for that mention.
But most importantly, you've been going on non-stop about the...
You've been very restrained during this podcast, actually.
Yeah, the revamp of the Strawman website. So I guess my question to the listeners is, could you please go to his website so he stops telling us about his revamp?
Check it out. It's new and improved.
I'll personally appreciate
Strawman 2.0. Yeah, it's it was a lot of work, but we've managed to make it live. There's still a whole bunch of stuff that we've got in the pipe.
I've got to explore the valuation stuff there.
But yeah, I think I always crap on and on about this, but it's just like, honestly, don't do it for the community. Do it for yourself. Write down some reasons as to why you're buying the stock. Set a valuation out there. You'll make smarter decisions, and I think it's good for you. It's good for the community.
I actually do think it is good for people if they jot down some thoughts.
Guys, look, thank you so
Andrew,
much.
did you have an answer for the last question? The routing?
I'm actually going to...
No, don't sit on the fence.
No, I'm not going to sit on the fence. I'm just going to boringly agree with you guys. I think
we were given two options. Do you jump in or do you wait?
Which is it?
The answer is it depends, right? The answer is...
I think that you just ease in.
Yeah, I don't even try and bother. Some of the best investments I've ever made, I timed horribly. And some of the investments that turned out to be really disastrous actually had some really early luck on the timing. The longer I've been doing this, I'm investing legitimately with a 3 to 5 year view. I really see timing as being one of those things that's less and less and less important. And it's also recognizing my abilities as an investor. Some people will be shouting at their audio device right now going, yeah, it's really easy and I do great at it. Well, that's good. I can't do it. And it's recognition that I can't time markets, that I don't try and do it. So when the market has a big rout, I'm generally excited because it means I get to put some more money at work. But I'm not gonna think things are all of a sudden fantastic because it's 10 or 20% cheaper. It depends on the context.
I think the answer is dollar cost averaging. If you sort of Google that concept, it gives you the most.
It's one of those. It's like diversification. It's one of those like guaranteed wins that you get in investing. It's one of those things that you can very, very easy to conceptualize, very, very easy to implement, and one of those things that more often than not will lead to a very positive outcome. Let's put a pin in it, gents. Thanks again. Matt, how can people get in contact with us if they want to?
So you can email us at 3wisemonkeys, wisemonkeys at gmail.com. And you can follow me at Twitter at mattjoss or mattjoss.com.
Nice. Until next time, thank you very...
You didn't do the outro for Claude, Andrew.
Oh yeah, Claude.
Well, let me just say...
Okay, and that's enough of that. Thank you so much for listening to the Three Wise Monkeys podcast. We'll be back next week with more. Until then, thanks for listening.
See ya.